when the money should have grown at around 12% per year at a minimum. It has grown at like 7% per year. And I was paying my broker, my advisors, a lot of money, to do this average subpar returns. And we felt that, oh, my money is in a big firm and they're taking care of it. Actually, it's not, right? So we wanted to make that difference because having been in this field, know how the money should be managed and whatnot.
People and their dreams. Welcome to Startup Saga. This is your host, Sanjay. So, this podcast, when we speak to our guest today, I think will benefit those who are thinking of becoming a founder, number one. Number two, who has already become a founder, they are in the first year of operation and they're kind of figuring out things for themselves. Those who wants to develop something, some kind of product. So, what challenges you face when you are developing a technology product, right? Number four, how to raise money through angel investment. So today we have with us Shyam Sreenivasan. Shyam, welcome to the show.
Thank you very much. Yeah, thank you.
Shyam grew up in Chennai. He did his undergrad in Coimbatore, and then he came to US and he did his master's in computer science in South Carolina. He also did his MBA finance from Water Business School, which makes two of us. It's always good to speak to, a buddy from same school. And from a career perspective, Sham has 25 year plus year of experience. Most of his time, 23 plus of year, he has spent in Morgan Stanley. At a personal level, Sham is married with two kids, and you know what? Both are in finance, right? He has a son and a daughter, and both one is already working for a Wall Street firm, and the second one, who's a daughter, she also plans to join Wall Street soon. And I'm just thinking, what they must be discussing in the dinner table. I'm sure it's not Italy, it's not dosa, it's all about financial stuff. So let's hear from Sham. What do you think? What he discussed during dinner table? But hey, welcome, Sham. Thank you for your time and welcome to the show.
Great. Thanks a lot for that great intro, Sanjay. I'm extremely delighted to be here in your podcast. You're doing a yeoman service for your listeners who are definitely having the itch to do something in startup, whether to be investor or to be as a founder and whatnot. But your service is definitely great. I love it, and keep it going. My journey is very similar to any other person, of our kind of a background, right? We come from a middle class family, very academically oriented, focused, do our engineering as a standard, degree, and then come here for masters, do something different, and then join a firm, and so on and so forth. The only difference I would say is at any point in time, I've taken a little bit more risk. I've always been a risk seeking person. So I along the way somewhere I actually took flying lessons to have be my hobby for a sense, right? So that's the kind of like risk taking that I've taken along the way, and this is part of the same thing. Is like chicks taking a little bit more risk than what other people would typically do, but rest of it I would say is very similar. The trigger point for my startup is when I one day looked at my retirement account, which is the biggest chunk of anybody of our investment style, right? And that was really not big, and it was not growing. And when I projected out in the future what it would grow into based on the history, what's grown, it was really shocking. When the money should have grown at around 12% per year at a minimum, it has grown at like 7% per year.
You are a founder for last 5 years now, right? And there are a lot of buddy founders are kind of are going to listen to this podcast. What is that you suggest that what kind of quality a founder should have? What are the 3 or 4 things a founder should have before he decides to launch something on its own?
Yeah, so the couple of things I would say is one is risk appetite has to be there, right? Because what you start, you are going on a limb, convincing your family, yourself first, your family next, because it is like as I said, it is going to be a ride. Initially, it's going to be a lot of hard work. You're looking at like 18 hours a day of constantly thinking, no weekends, no holidays, that kind of thing, and then you're then convincing your family to you know pitch in your capital that is required, because at that point they are the best support. Your friends are coming in next immediately. So there's a lot of people that you're trying to convince what you're doing, and of course part of that convincing is your commitment. You cannot be like, okay, I'm going to take a 9 to 5 job, I'm going to do this part time. There's no commitment there. So you have to give up something to get something else, right? The second thing I would say is optimism, right? Things are not always not going to be like very promising. People who came to you knocking your door when you are in a career job, now you're going to be that knocker of the door. You're going to knock 100 doors. One door may open, 99 doors may close. So you got to take that no as an answer, but not get depressed by that answer, but to be able to like take that on in your stride and move on to the next door.
What about a financial aspect? Like, did you plan that you will see this working for you for X number of years? Because in prior podcast, rule of thumb 3 years. How did you look at that?
The way I did it is like when I exited out, I was planning for not having a paycheck for at least 2 years.
These 2 years. How did you decided which form of company you want to form? Like, did you check with your CPA, lawyer, and what would you advise for budding founder? How they should actually go about when it comes to setting themselves up?
Right. So if it is going to be a smallish startup, like say somebody who is joining, who's starting a consulting firm of sort, and they're expecting their company to have 5 to 10 employees, it's better to do an LLC. You're not going to really need a lot of money. A lot of money is going to come in terms of your services. So the startup in consulting world is very different to starting up a product oriented company, because a product or until you finish the product, there is no real revenue, right? You have to develop the product, and then you really eventually scale it up by attracting partners and clients and so on and so forth. Whereas in a consulting firm, your service is your advice, right? Even whether it's a technology or otherwise, it's basically lending you your expertise to your clients. There the capital is, as you're doing service, you get capital, sort of like it offsets itself. In that case, LLC is good enough. You're not going to need too much of money to be raised, and probably a lot of investment firms are not really interested in a consulting like startup. So because you're almost like providing a service which is niche skills, whether it can scale up or not is a question. Whereas in a product company, potentially the product can scale up, and that's where you really have to think of C Corp as the way to go to get started.
So, how did you develop your first product, and what were you thinking about
So the very first thing I did was I had some seed investing all the way when I started.
it? So, you already had
I
somebody invested in your firm.
somebody very close friend of mine investing like a $500,000 just with an idea that I had, and he was ready to jump in uh, and give that kind of initial seed money. And that was a very good starting point for me to hire some individuals into the firm, at least for a 1 year kind of a commitment.
When you say some number, is it something like, hey, no, I need X amount of money. I do not have a valuation in my mind right now. But when the first Series A comes, whatever valuation that is at that point of time, you get it at say 20%, 30% discount. Is that one of the conversation?
That is one style of doing it. There are a lot of gotchas that you have to be aware of when you go with that kind of an approach. That's called a safe note, which is basically like a convertible note. You are saying whatever is the future pricing, I give you at a huge discount from that pricing for what you gave me.
Mm.
Let's say you gave me a $500,000. My company is going to be valued when we go into a Series A, which is probably 5 years down the
Yeah.
lane. And this investor has to wait for that long to for this money to be even known how much of equity he has or she has. But if some investor comes along the way in between and they say, I can only invest if it's a priced round, meaning you tell me what the valuation of the company is, then at that point, everybody gets priced. Prior to that, whoever has invested gets priced. And you're like, when the company is only worth, let's say, $10 million, somebody gave you a 500K, you're giving close to 5% of the company for that 500K investment, right? As opposed to the person waiting for the Series A and pricing it at a $30 million valuation and get a 20% discount on that or whatever, and then making that 500K worth 20% discount on the $30 million. So there are two different parts
What
to
was
it
your
because you
experience?
never know what the future is. So it's better to always go with some standard pricing number at the early stage, let's say $10 million, right? That's just a trust between you and your investor to say at least it's going to be worth $10 million. If it's not, then it's not worth an investment, right? Even an idea as a founder, you at least have to make that investment worth $10 million, right? So you start off with a 10 as a base, and this number could be different for different industries. I'm not making a broad statement. I'm telling from a fintech point of view. But if it's $10 million and get the first seed invested to a price round, and because that's a huge trust that the investor is having at that
Absolutely,
stage of your
absolutely,
growth,
yeah.
then once you have a product which is a prototype, you still have no clients and whatnot. You have a prototype, and you have to now go and hit the market with that prototype. With like, say, hey, can you do a proof of concept project with me? And you get some partners along the way to do it and whatnot. The $10 million valuation could potentially become $15 million valuation at that point. Then you go to the next round of investors. Say, hey, here's a product. It's no longer an idea. It's not pen and paper. It's real tangible product that you have now that has some value beyond where you started. So let's say it's $15 million valuation. Again, it's a price round, or it could be a safe round at that point in time. But then you keep going for the next stage and so on. And eventually, if you do well, you get into Series A.
So, first investor, I think a lot of faith in you. I'm not thinking about any valuation for that person. Very unique situation. How did you manage to get the next, second and third round of angel investor? Is it still the same level of faith, or did you show them some data or some MVP? And that time you kind of at a high level gave them a valuation. Like, how was your experience in second and third round of angel investment?
So by the time you come to second round, you have something to
Sure,
show in terms of product, both progress from things where you have control, which is technology, right? If it's a fintech product, you have built something, you have developed something, you're able to show what the value of that particular product is, and so on. And of course, if there are any progress along the customer traction, you can also
sure,
show that.
sure.
And still, the numbers are still very fluid
Correct.
because what you're going to price when you're at a proof of concept is almost like not priced at all. You are asking for a favor from your vendor, sorry, your clients, to say, hey, can you try this product? I'm going to give it for free unless and until you feel that this is a valuable product, and so on. So again, there is nothing to back up as a valuation. Even if you had some pricing, that's the early stage of pricing. You have to try to replicate it across multiple clients to make it really a believable price, right, or a believable value for your company. So the second stage is slightly more. At least you've started to think in financial terms, right? In the second round of angel investing. And the third round of angel investing is even more hardcore. Okay, I've got a product, I've got some traction, I've got some cash flows. Now I need to multiply that with some marketing dollars, hiring sales force, sales team, all those different things. So it just becomes increasingly more concrete from a fluidity that you started off with.
So, how much you have raised so far when it comes to angel investment?
We have $2.3 million that we have raised, and we are in raising $3 million as the next round. It's still not a Series A round. We call it pre-Series A round. So we are just starting to raise $3 million. It comes from multiple investors. We have raised 300K of the $3 million. So far we've raised 2.3 plus 300 of the $3 million.
2.6.
Building the product, right? Using the resources. Just because you have a lot of money in your bank doesn't mean that you can spend the way you want or you can pay the people that you want. You're still in a very thrifty mode. Should I pay myself the market salary just because I'm the founder? I can decide what I can pay myself, or is it justifiable? Is something so you wear a different kind of hat to say, if I have not earned it from the customers, should I pay myself any salary, and if so, what is that, right? And so that constant process of ownership mindset to say that my commitment is for my investors because they've trusted me, my employees because they've trusted me, my family because they have trusted me, and finally myself.
And where do you record these shares? Like, again, something, it's not a very structured place. Is it like some company managing this cap table for you, or is it in an Excel sheet? How do you make it very, very legal and official for
So
the investors?
typically there are two approaches to it. One is the law firm that you use to set up your company and whatnot. The second thing we did, we started off with the law firm managing our books in terms of who is investing, because they have to be involved creating the paperwork anyways, right? Because when you say every round of funding, you have to get the term sheet, they are the ones that's actually creating the term sheet. That you have no choice but to go through the law firm. The part where we started maintaining who is investing, copying them on the DocuSign so that they get a copy of the agreements that we have with investors, etc. That was easy. But then we shifted from that into JP Morgan's corporate business account that we switched over. It's not the regular JP Morgan business account, it's a corporate business account. It's a different entity within JP Morgan. And they provide a lot of different services for startups. We get invited for a lot of these drinks in the evening, like networking events, to meet with other founders, investors, etc. So with that corporate business banking relationship, you've got this tie-up. They have the tie-up with a company called Global Shares that is basically a cap table managing software. Up to about, I don't know the exact number, up to about 100 investors on your cap table, they don't charge you anything to manage the cap table. Mm-hmm. It's a very well designed software.
So now shifting to the product side, so what are those two products, Shyam, if you can share with us, and what problem they're solving?
So Quantel.ai is a risk management focused on investments that people who are mass affluent and above have. If I have only $100 in my account, it really doesn't matter. So the early stage, it really doesn't matter. But if I have a $500,000 of account, then I have to start thinking about what is the best way to grow that money with all the opportunities that's there. At the outset, I was saying about your retirement account is the biggest chunk of a typical investor's account, and we all gloat on the small amount of money that we made on our own Robinhood trading. Hey, I invested in Meta and went twice as much in like last 1 year. But how much of that wealth that you have that includes your retirement account is that particular investment? Probably not a lot, right? We feel like we are very successful investors with all our one-off trades that we do. That we could just be lucky. We may be in a dinner meeting and somebody says a particular stock and we have a view of it. Tesla is like one commonly
happens quite often, yeah.
All the time, right? We keep talking about how Tesla went up or went down, and we keep debating in our WhatsApp circles and whatnot. That doesn't mean a thing in the big scheme of things. When you retire, all these small investments, you either made money or lost money, doesn't impact you at all. The biggest chunk of your investment retirement account is that grown 3 times from when you were 45 to when you're 60, when you're about to start using that money, right? If they haven't done that job, if that is ignored part of your personal wealth, that's where the difference really comes in. Because we are SEC registered investment advisor ourselves, we use a lot of AI based strategies to invest your money. But moving money from your Fidelity account to us is not that easy, and because your Fidelity is some relationship that you've had for ages. So keep it there, link it, look at what your investment is doing, compare it with every other investment that you have. So it's a tool set that actually provides you the inside story of your investments. What are the risks that you have? What are the opportunities that you're missing? And so on and so forth. Then now you can take your own decisions, or if you're managing your own money. If not, at some point down the lane, you can also move that money into managing with us. So we currently have partnership with Interactive Broker, and we are expanding into Charles Schwab and Fidelity and whatnot in this coming year. The first part of it is linking, getting advice, and you doing it. The second stage of our growth is at least portion of your investments can be migrated to us, and we can manage it, on your behalf, like a hedge fund.
What is so different about Tangent AI? Like, how is it different from other competitors in the market?
So one is we are not passive. We are actively managing investment with the current market conditions, or the market conditions expected for, in the AI sense of things, the next 3 months. We don't say anything about the next year because AI is very good with forecasting something in the short term with the historical data. And we have internally developed a proprietary signal as what we call the market signal, or TAMS, or Tangent AI market signal. That is basically the driver for how much of your portfolio is positioned in various different themes or sectors in the market. Sometimes we may be taking some of your investments into cash. The market is in a downward spiral. It's better to sit on cash as a hedge rather than deploying all the capital in some investment that's going down in value. That determination of how much is in cash, how much is in technology, how much is in growth sector versus value sector is all algo driven, which is driven by the Tenjin AI's proprietary algorithm. That's what the key secret sauce is. So we have close to 200 managed accounts. We have close to 200 or so advisory accounts, and some of these managed accounts can also have advisory. So you're not precluded from one if you're doing the other. Like I said before, you can have $1 million account. You link it first, and then 100K you can start off with like Tenjin managed account, right? So we have customers like that.
Mhm.
And overall, Tenjin as a app also has got a lot of other benefits. You can link all the account for free without paying anything at all and whatnot. We have close to 1,500 customers that way. So people linking the account, getting advice on like what's moving up, what's moving down, just being aware of like what's going on in your portfolio across. You don't have to log in 10 different times. It's all in like one place. That we have about 1,500 users that's using the product right now.
So
And the goal is to scale it up to a larger client base, offer it as a B2B2C platform for other B2B players. And that's the direction in which we are going, taking the
today it
product.
is pure B2C.
Today, it's pure B2C.
And
And we are currently working on white labeling the product with a B2B customer. So we are in the early stage of discussion there. But once we have it, then we have a customer base, which is more than 250,000 customers that can potentially use the product as is, but with a different logo on top.
so the money you are trying to raise, is it because you want to make it a B2B product?
Correct.
Okay.
We want to say do sales and marketing primarily for B2B.
Are you profitable today?
We are no, we are not breaking even at this point in time. We are very close to it because our cost of marketing is there, and a cost of people is also there. So we are not at the break even point, but most probably by the end of 2024 we should be in a break even.
And current valuation of the company and what valuation you are trying to.
So we are basically doing the safe note, the convertible note, as I mentioned before, as a $30 million cap on the valuation with a 20% discount on the
That's a
valuation.
pre
So when we
that's
priced
a
it,
pre-revenue,
when
the pre-CD A basically.
pre-series A, yeah, pre-series A. So $30 million cap. So if we get priced at $50 million, the current investors will be capped at $30 million, or they would get a 25% discount, whichever is low.
Okay.
20% discount, whichever
Is
is low.
the investment option open for people? Okay.
Yes,
So anybody
yeah,
watching can connect with you and talk to you. Okay.
absolutely, yeah.
So what has been your learning when it comes to scaling, right? Like you started something in 2018, you developed the product, and you scaled. So can you share your experience with other founders who are in the first, second year of their operation, how to scale?
Yeah, scaling. In the first 2 or 3 years, one you have to just focus on the product and the USPs of the product, whether it's viable as a business entity, etc., etc. You're still looking at the first 10 clients that's going to be extremely happy, whether it's a B2B client or a B2C client, right? So the goal post is not very different whether it's a B2C or B2B. Of course, the scaling becomes a challenge, in the B2C more than a B2B, because the amount of revenue you make on a B2C customer is not going to sustain yourself unless that can translate into a thousand-fold increase. Whereas a B2B, you just need one extra client that's going to give you that extra revenue and whatnot.
It's 5 years for you, Shyam, in this startup journey. Um, if the God comes and tells you we give you back 5 years, will you start again or?
I would probably do some aspects of it very differently, because as I said, a product does pivot itself over the course of the period. Probably if I had the same exact 2018-19 that I started off with, I would probably redo things slightly differently if I had known the future. Like, if you know tomorrow where the stock is going to be, you would invest the right way, right? So clearly, if God were to give me that, there are certain things that I would
What
probably
are
have
those things,
saved
Shyam?
of my. No, I think the focus of the B2B channel
Got it.
approach,
Okay.
uh,
That's one.
the amount of time that we spent on a particular client and giving all the time, and eventually that had to be pulled back and all those things, that we would have probably avoided.
Now, did anytime in this 5 year, Sham, you came to a situation where you said, I'm not doing it. Like it really, you wanted to go back. Did it happen with you?
Fortunately, I did
Hmm.
not, and I'll tell the reason, right? So when COVID
Hmm.
hit, we could have gone into a complete
Hmm.
wall and not knowing what to do, right? And if we didn't have money at that point in time in our bank, we would have probably taken that coin kind of a call. But fortunately, we had enough money in the bank at that time because we just finished raising the capital, and it was much easier to raise capital in 2020 or 2019 before COVID hit. So we were flush with cash. We were still very smart in terms of using it in a more, thrifty manner and whatnot.
Startup may sound very exciting, fancy, but one has to be very, very thoroughly prepared, have a strong heart, because there can be times which will be so difficult and you can say, look, I'm kind of giving up. So be very, very clear in your mind what you are getting into. And it's a long haul. I've had other people speaking with me. So kind of similar story, right? Grit, determination, long haul, and that vision you must have. Now, what next, like Sham? What are you thinking about?
So one thing I would add on that, Sanjay, is startup as a founder is not for everyone. Startup as an investing
I know, I can
opportunity
touch.
is for everyone.
I'll just add to that what you're saying. I'm seeing in the last 12 months, a lot more people are taking a share of their portfolio and investing in startup. And they're doing in exactly that 10K, 20K into 10 different startups. Are you going to sell this to somebody? Is it an exit mindset, or you want to carry on for 10, 15 years? And if you sell, who will be your potential buyer?
So our exit plan is already there, meaning we want to take this product to a B2B adoption using a white label approach. Get few such clients, which we've already started to talk to, and there's a B2C angle also with it, like to scale the current number of people, because this 1,500 people is an organic growth with very little marketing, if at all, right? Our digital marketing is in Facebook and Google ads and stuff like that. So we want to scale up the B2C part of it to at least 100,000 customers on the platform. Then we also want to scale it out into global market, because what we are doing in the US is replicatable, because at the end of the day, all of it under the covers is data driven. And as a platform, it can lend itself to markets like India, where there is a billion plus people, a lot of young folks converting into like digital investing and whatnot. So we want to take that product as a next stage of growth from B2C to scale up the number of users to 54s from where we are, get few B2B customers as a platform, customers. And then at that point, we will be looking to exit out, selling it to a larger firm that can actually take this under their umbrella and go from there, right?
No, thank you, thank you. I mean, this has been a great learning. So what we learned from you is, like, how to start a company, how to talk to different CPAs and lawyers, and then how to form a team of investor, how to form a team of employee, what you can offer them, how to develop a product, how to scale a product, and then next round of investment. I think you are following the process very, very well. So I wish you best of luck in the future. It has been a great
Thank you.
learning from you, and I wish a lot more customer, and I, best of wishes for a lot more customer to join your Tangent AI. Maybe I will also connect with you offline. And thank you for your time. And guys, this is Sham for you. The way I read you, Sham, you are a person a little bit intense, but very determined, grit, very strong, and Talaiva on his own way.
Thank you, Sanjay. It's definitely an honor to be presented on your podcast. Thanks a
Thank
lot
you
for
so
that.
much.
Yeah,
Thank
opportunity.
you, guys. Thank you for watching
Yeah.
this podcast. We'll see you again.